What's going on, everyone? Lalit here. Today we got 13 investing mistakes made by beginners in the stock market. We'll be tackling it both from a long-term investor standpoint as well as more of the day trader, swing trader, short position perspective as well. If you're new to the channel, we talk about stocks, credit, personal finance in general. And if you don't have any brokerage accounts at this time, all of your Webull, Robinhood, M1 Finance, Cash App, affiliate links down below in the description. But with that, we'll get straight into it. The biggest mistake anybody can make is literally not starting. If you don't start, you can't make any of these other mistakes. Basically, over the last 10 years, the S&P 500 has literally almost tripled. So if you haven't invested, you haven't seen any of that action, any of those gains. And sure, the market could have been downtrending for a few years, and at the same time, if you didn't invest anything, you won't actually feel any of that loss. But basically, if you don't start, you won't be able to make the other mistakes and actually learn on this journey of investing, making money, and if you're a trader, making money that way too. Let's start off with an example, and that will lead us to our second mistake. Let's say we have $100, and let's say we deposit it into some arbitrary brokerage account. But for example, if you check out Webull, you get 2, 3, even 4 stocks with the links down below. So now you started off with $100 in terms of your investment journey, or if you're learning to trade, then your trading journey, but overall you have $100 into the stock market. So now that $100, let's say if you have a year like 2020 and you're a long-term investor, even putting this money into mutual funds, ETFs, certain broad index funds, you could have literally made that 100 into 150 and even more depending on where you invested without any active type of work. And this is in the investing side. Now, if you're a trader, you could have made that 100 into maybe even 1,000. You could have maybe 100 to 50 and that 50 became 500. It just depends how you're executing your trades. The point of the story here is you've started to get into investing or trading, but basically getting involved with the market. But the second biggest mistake is called literally waiting to invest. Like we said, the S&P 500 has gone up over 3 times in the last 10 years alone, and it's gone over a lot more in the last X amount of years depending on where you see your investment journey heading. The point of this is to explain that basically you may have started off and your 100 could have become 200, or maybe your 1,000 becomes 2,000. But the point is, if you don't invest more, you're not seeing any new gains on new money that's added. So if you think that, oh, the stock market is expensive, or I'm going to wait for a crash, or you're waiting for something arbitrary to happen just to influence your buying decision, if you're a long-term investor, it doesn't really matter when you're investing as long as you're dollar cost averaging or have some type of system where you're constantly getting dollars or any currency into the market. On the other hand, if you're a trader, waiting to invest may be better than just trying to put money and trying to make it into more, especially in the learning phase where folks lose a lot of money up front until you really understand the skills and expertise that come with trading and the trading atmosphere in general. But with that, and a lot of risk averseness based on public sentiment that exists in general for anyone dealing with the market, waiting to invest, even from a trader perspective, you may learn bigger lessons later with bigger amounts of money. So in other words, it's better to learn fast, where instead of just waiting to have some type of sizable account just to, in other words, blow it if you don't know what you're doing, you might as well take shots and practice along the way as your account size grows. But don't wait, because if you just wait, that's great, but there are no lessons being learned. Money's not growing if you're long term, and if you're short term, you're not doing those next steps to make even those bigger moves in the long term. Moving on, it's a common one, I'm sure you've heard of it, and it's called buying the hype. If you buy the hype as a long-term investor, it may not be the best decision for the long term. If you're buying at huge prices relative to where a company should be valued, then basically from a long-term investment standpoint, you may be paying more today, and sure, you can dollar cost average in and get your average cost down and maybe have more profit down the line. But the point is, if you're buying the hype, it's usually hyped up for something in the short term. And the stock market is forward looking, and so buying the hype today is an expectation of some news to happen, maybe with plans for a company a year from now, 2 years from now, maybe 5 years from now, depending on the industry. And so buying the hype today doesn't mean that the stock will actually keep on appreciating in the long term, because that's not guaranteed. If you're a long-term investor and you buy the hype, you may be spending more today. And so that may affect your overall portfolio or your plans 2 years, 5 years, 10 years from now, because in the end, you bought the hype today and it was hype. But when people buy the hype, there's also someone selling the hype on the other side, making money. And so segueing that into traders, and if you're buying the hype as a trader, you better really know either A, what you're doing, B, be on top of it in intraday positions if you're day trading, but overall you can be involved with hype stocks to make that quick money. But if you're a long-term investor, literally what I'm explaining about the trading side is that the traders are there to make money. And so if you're investing, it may not be the best time to buy and hold for a long-term position unless you do have some thesis or you did your DD, aka due diligence, accordingly. Talking about hype stocks, where do we even get to know about these hype stocks from? Hype is usually generated from the media, potential stock experts, potential Jim Cramers of the world on CNBC, and the like. And by folks like me on YouTube as well, just talking about some stock that's making us X amount of gains, and hey, maybe it's a great idea for someone to get into it as well. The point of this is to say that don't really trust every single media outlet, news source, stock alerts. Stock alerts, what are those? Stock alerts is literally some groups, like these day trading alerts, that literally there's people that text you, hey, buy this stock now because of XYZ reason, and then say, okay, get out, or they don't even tell you when to get out sometimes. And so it doesn't make a lot of sense. But the point is, if you listen to everyone, that's great. But you're going to be trading or buying on public sentiment, which the information and the slogan pretty much goes like, when you've heard of it, then it's probably too late, aka buy the rumor, sell the news. It's good to get intel in terms of maybe what's actually trending or what are we looking at in terms of industry growth or certain areas within the stock market that are probably important to understand, maybe due to some economic reasons, for example, decreasing interest rates, etc. And so from a long-term perspective, listening and understanding is great, but again, just do your homework. And if you're a trader, it kind of is the same thing where you can get to know of a stock, but in the end, if you're not looking at the charts, you're not doing your pre-market kind of screening and understanding, you're going to get in that same boat where in the end, why they say stock market is gambling is literally because if there's no actual science or strategy around it, it's kind of like, okay, we're just putting money into something and expecting it to grow, and that's great, and you know everyone gets lucky once in a while, but from it being called a mistake is literally not taking the best and optimized basically plan of action to succeed and make those gains. Number 5 on our list, we got buying because of fame. And what this really means is basically maybe it's a brand that you're very familiar with, and just because you're familiar with it, that could be a great place to start and understand why a stock price is what it is and what goes behind it. What is market cap and how does that relate to maybe other companies in the same sector, and getting your path into understanding more. But for example, if you shopped at the Gap maybe growing up and now you understand that, hey, the Gap owns Athleta, Banana Republic, as well as Old Navy. And if you're still shopping there, it may make sense like, okay, hey, you know, I shop there, kind of understand who's shopping there. You kind of understand that public sentiment, but then you may want to look under the hood for the numbers because maybe after the fact, it may not be the best decision. On the other hand, if you look at Starbucks stock is insane. And from a dividend perspective, it's a great payer as well. And this year alone, it increased its dividend by 10% annually. And so from that perspective, Starbucks, maybe it's not the best decision to be made as someone who is frugal, maybe to go spend $5, $6 every single day at minimum once a day, which is great cash flow from a company for Starbucks to get to pass on to its shareholders, but maybe day to day, it's not what you may agree with for your lifestyle. But when looking at it net, basically there is a company that like Starbucks that we know of, it's very famous, and maybe we don't consume those products, but at the same time, there's a lot of money to be made and a lot of money to be left on the table by not doing said research. This goes for both long-term investors as well as your traders, because either which way, if you're just buying because it's a hot stock or famous, if it's famous, then maybe there's more volume on it, like your Tesla, your Apple, your FANG stocks. More volume equals basically more ability to be filled fast, less bid-ask spreads as traders. If you're an investor, if you're buying the fame, you got to really look at, is it a trending fame? Is it just a hot topic? Is it just something that's trending now in the next maybe 6 months to a year and earnings are going to crush it? AKA, even if you're long-term investing or investing for a year or 2 years, just have a plan of why you're entering and when you're exiting items like this. This all naturally segues us into the next mistake, which is basically have a plan and have a why. Without having a plan and without having a why, basically, if you don't know why you're investing, if you just understand that, hey, it's good to put in, some money for your retirement, but not understand maybe how much you need in retirement or how much money will you pull from your stock market portfolio. Is it going to be only the dividends that are earned per year, or is it going to dig into that principle and what does that look like in the long term from a cash flow planning perspective? And naturally, if your portfolio makes up all your expenses, if you plan life like this, then how much do you need per month, per week? What about miscellaneous expenses, emergencies, etc.? So maybe investing isn't for any of this. Maybe there's a situation where you're making cash flow, maybe through a business that you're a part of, and all your money you're making actively, you're making it there and you're happy as is. investing is great, but maybe investing is not something maybe you feel that it gives you stress and you don't want to participate in, and that's okay. But it's all about having a why and understanding why you're doing something. Now, let's say you have that why. Whether you're an investor or a trader, it's all about the what's next and what's your plan. So when you're getting into a position as a long-term or short-term investor, basically when you're getting in, when you're getting out, what's your thesis, why, what are some conditions maybe you want to consider of when do I want to get out? Well, if a stock goes down 50%, it may or may not be the best time to get out because of certain mistakes we'll follow along with, but maybe that is an indicator for you saying, hey, it went down this much and I don't really want to deal with this. Whatever reason it is, as long as you have a reason and you're okay with it, then go for it. And if you're a day trader, it's the same logic, from your stop loss orders to putting up some type of system to actually limit your losses, but also when you have those gains to take profits accordingly. At the same time, have a plan. The background behind timing the market, if you just think at a high level, if you're timing anything that involves everyone making a decision at the same time, and you're trying to think about what that situation will look like when you have 100 people or 1,000 people or tens of thousands or hundreds of thousands of people at the same time doing something, in this case buying and selling some type of stock or security on the stock market, if they're doing this, then that's influencing, due to the demand and supply for the stock, the actual price, the direction of the price, and where that price will be. If you knew all of this information instantaneously and exactly what was going on, then not just you, but anybody who knows this, you can come and try to DM me or reach out to me because I'd love to know these secrets. Jokes aside, it's like saying timing the future. And so if you can't tell the future, then basically timing the market, it's not going to work out. And so they say, do not time the market because the future is unknown. So if you try to time it, your actual intended result or conclusion or whatever you may want, it won't come to fruition so easily. So taking this again from the investor first perspective and then moving on to the trader one, basically as an investor, if you're trying to time the market, it may or may not be worth it depending on how long your position is and how often you're investing into said stock or security. For example, if you're investing $100 every single day or every single week, for example, into some ETF or index fund. Now, $100 a week is $400 a month, and times 52 weeks is roughly around $5,000 for our example. So within this $5,000 every single year that's going into the stock and $100 every single week into the stock/fund, basically what's really happening? Basically you're getting an average, dollar cost averaging, throughout some type of period for that stock's price action. So if you're trying to time the market and you're doing this strategy, then basically you're kind of seeing the benefits of having kind of the midpoint price between the absolute highs and the absolute lows, and you've been averaging in for X amount of time. So if you're trying to time the market with this strategy, it wouldn't really make a lot of sense. But the more common one is literally, for example, in 2020, when everything went down heavily, people were buying a lot on the way down, but there was a lot of talk of people not buying on the way down because it was like a falling knife, where you never really know where that bottom is. So if you just bought in the initial times when the circuit breakers, they went off in 2020, that's a great position to buy in, but it went even further down below. On the other hand, if you were averaging up from the bottom, you saw some up, kind of the V-shaped recovery of, hey, let's just put in money, it's only going to go up, it's going to go up, it's going to go up. You can time it that way too, but what if the V-shaped recovery didn't happen? What if we didn't get stimulus? What if certain measures weren't invoked to actually result in that outcome of the way it did? From a trader perspective, if you're trying to time the market, it's not that day traders need to win 10 out of 10 times or time it 10 out of 10 times perfectly. But for example, if you have the same amount you're investing or trading with and the same type of profit gains where you cash out and your same stop losses where you actually sell to limit your losses, etc. If you have this type of system in place, then basically if you're winning 7 out of 10 times, you can lose 3 times, or even 6 out of 10, you can lose 4. But the point is, as long as you're winning more than you're losing, net, there is profit to be seen. So the mistake of timing the market is a mistake in itself in terms of never really being perfect. But how would you solve something like timing the market? It's basically going back to the first investment example of just DCA, dollar cost average, or invest, for example, every quarter if that's your way, or every 6 months, which is less typical. But again, there are some folks that maybe get a bonus 1 time a year or 2 times a year, or maybe a tax refund time is when you put money in the market, and a bonus time and you never invest otherwise. It just depends where it is on your priority list. And so just not timing the market perfectly, but trying to invest consistently is what can solve this type of mistake. Next on the list of mistakes is actually getting into financial tools or financial instruments without education. If you get into, for example, options, and you don't really know what you're doing, you just know about the insane gains that are made by all these folks on Reddit through the subreddit Wall Street Bets, and you just see them making huge money off of Tesla, where they'll be putting in, let's say, $500 and literally $1 million is the result. If you're seeing these type of ideas and everything, and it's really attractive, and I get that, and I was there too, and one of the biggest mistakes I did was literally just buying an option contract without understanding implied volatility, without understanding theta decay, without understanding how the price of the option contract fluctuates closer to the expiry, just simple things like this. Because in the beginning, it was just like, okay, fun money, let's see what happens. And that's great in a way if it was fun money, but what if it was real money and you're really trying to earn said money? So if you're a long-term investor, all of this quicker money is really attractive, I'm sure, especially when you have a long-term investment. You actually maybe are tracking your investment and understanding the price action in the short term and maybe expect it to crush earnings or maybe expect it to outperform or maybe underperform. And then you may want to invoke some of these option contracts on your positions. But in the end, this all came from kind of understanding more about the stock market, understanding what type of investor you are, understanding the trade-off. If it doesn't go your way, what does that really mean? On a trading perspective, let's say you're new to shorting stocks. If you don't understand what this means when you're taking on margin and what the actual conclusion could be after the fact if things may not go your way, what is your maximum loss potential? And items like this. So basically just understanding and learning the landscape, and practice does make someone better. And it's great to try out concepts, but again, just try them out, not frugally is the word, but basically with some type of reasoning. All of this takes us into the next mistake, which is not understanding all the different ways to make money in the stock market. For example, you can make money in the stock market by just capital gains. So if your stock goes from 100 to 150 and you had 100 shares, then you're making 50 times 100, aka $5,000. Then you have dividends, for example, which are going to be those thank yous from companies for just holding on to their shares. There's items like within options, you have strategies like the wheel strategy, where you're basically selling puts, selling calls, and based off of the position you have or the collateral in terms of money you have just in your brokerage, which is just sitting there, you can actually collect passive income or actual money in terms of premium on the said stock that you have if you're selling calls. And if you're selling puts, maybe you want to buy certain stock at a certain price by a certain date, and you're actually going to be compensated for that, for getting into that contract. And that premium you're getting is not just passive income, but in reality, it's decreasing your average cost of the position in general. So the point of this is to explain that basically, whenever I joined the market, I thought of, okay, penny stocks, like, quick gains, in and out, no worries. If I got $100, then I can buy even more shares, feel super rich. And I was very young at the time, but the point is all of that is, super sexy and everything, but what's going to happen after the fact? So from penny stocks, okay, that's cool. That's a certain segment in the stock market. You can make quick gains, but then otherwise, maybe it's kaput, but maybe not. And folks with options, whenever people hear options, they just hear risk, or you could lose it all. You can lose money fast. And one of the biggest proponents is, okay, if you invest, let's say $1,000 into some trade, or try to trade with that 1,000 into some type of contract with options, then basically your worst case, if you're buying, let's say, a call contract, is that, okay, you bought a call and it can just go to zero. So whatever you invested just goes away. On the other end, that same 1,000 can become 3,000, 4,000, 5,000 in a very short amount of time, depending on the stock and volatility and time frame. But items like this, is it worth to risk $100 every time, where your upside is 3, 4, or 500, where you're going to lose 100 each and every time? But again, coming back to that concept, if you win 7 out of 10 times, then as a trader, it actually may make more sense to take these type of risks. So overall, understanding where this money comes from, how the flow is, what your risk is in terms of actual dollar amount, what the time frame is if you're dealing with certain types of financial tools like options, then basically just understanding more is one of those things that it can rectify the mistake. And it's never really a mistake as long as you're constantly learning and just being proactive about understanding more and learning more, and then making that strategy and plan. Next on the list, we got panic selling. It could be related to timing the market, but the reason I wanted to call it out as a mistake of its own is literally what we talked about, for example, in 2020. If you sold at the bottom, I mean, that's fine, but then you couldn't have ridden it all the way back. And simultaneously, it could have gone even further down. But eventually, just like the stock market, there's some support, there's some resistance. It doesn't just go poof, is the hope. So the point is, where we're talking about panic selling, if you're a trader, if you're selling too much in panic, then basically if you already have a plan, like those stop losses on your actual losses, then basically you'll be capping those losses at a certain amount depending on your strategy. From an investor perspective, panic selling not only ruins your long-term outlook, and it's ruined just because if you sold in panic during, for example, the 2020 at the bottom, what happened, then when would you ever get back in is usually the next question. And so if you panic sold, then let's say now you sold, now you have cash on the sidelines, now the stock market's going up slowly, now you're waiting to invest, mistake number two, and you're just waiting, you're on the sidelines, you're like, okay, it's gonna be fine, we'll figure it out. And then before you know it, now you're sitting on the sidelines, things are more expensive than they were, you don't have a plan of when to get back in, you also have this cash on the side which is losing value as we speak just due to the way inflation is and the way of appreciation, aka your opportunity cost by putting that money into something that's making more or at least keeping its value, storing it, and then appreciating, for example, like the stock market. So just looking at this overall perspective, panic selling is really a mistake in itself. And when it's actually going down, the price that fast, or in general like a downtrend, just getting in and putting more money is usually what the strategy, quote unquote, is, assuming it's fundamentally a sound investment, part of your plan, etc., etc. Second to last on our list of mistakes, it is IPOs. IPOs is on this list, and I have a bittersweet relationship with them. For example, I bought Square during its IPO time, and I was more of a beginner investor at the time. And so I bought Square, and it was a time when commissions were still $9.95 on Schwab, E-Trade, etc. And I bought like a few shares back in the day, and I didn't know anything about lockup periods, restricted periods, nothing. So, you know, it went from wherever it was, 11, 13, that range, all the way down to like 8s and 9s. And I was like, okay, let's just wait till break even and let go of this. And a year later, it kind of came back to that same IPO, similar price to where I bought it. And I still forgot about those commissions that were there. So net, I took a loss because I broke even on my share price execution, but I spent literally money on commissions. But the point of this is to say that look at Square, where it is today. Phenomenal stock, insane company, all the beautiful comments in the world, but I didn't keep a position from back then. And similarly, if you see some other videos on the channel, for example, there's a company like Palantir, which IPO'd recently, and I've been making a lot of gains on the option sides of selling calls, selling puts, just trading it in general, and just holding some stock as well for the long term. And so that's an IPO I participated in terms of buying it on IPO day, and then I bought it and I averaged in over X amount of days, and usually it's 3 days after a stock comes on to the market where options are available. So I was kind of averaging in to get 100 shares to do this type of process. But coming back to the story, IPOs, you can make a lot of money, you can not, and if you're a long-term investor, it may make more sense not to get in immediately in the beginning timeframes. But if you're a trader, depending on what you're seeing, how hot it is, how hyped up it is, for example, just 2020 being a year with so many IPOs and huge valuations, there's just a lot of participation in the market. And so as a trader, from a volatility perspective and kind of the gap ups that can happen from day to day, and depending how you trade, there's a lot of money to be made with IPOs as well. So from a disadvantage standpoint, IPOs are kind of that initial public offering, or with Palantir it was a direct listing. But the point is, what is the outlook? What's actually going to happen? And that's kind of the uncertainty with an IPO. It's the future that's uncertain. And so you're buying it today, hoping for more gains in the future. So either you participate or you don't, but definitely just have a plan, because if you don't have a plan and you buy an IPO, it can 10x. That's great, but can also not 10x. And if you look at a company like Slack, for example, it got acquired by Salesforce recently at the time of this recording. But before that, from its IPO, if you look at the graph, it's not really sexy. Right before we get last on the list, we talk about stocks, credit, personal finance in general on the channel. So thank you so much for coming to the end. And it's one of my favorite ones to share here today. And it's going to be the growth mindset for your account. I've been seeing this around consistently where folks have this small account, and whether that's 1,000, 2,000, 5,000, whatever small is in general relative to other money you would be willing to invest, overall, this small account mindset is basically like this. Let's say I have $1,000 to invest, and let's say I consider this small. If I have $1,000 to invest, and let's say my goal is I want to make $1,000 into $5,000 within a year trading. Now, this is great, and what people usually say is, man, if I had 10K, then I get 10%, and that's 1,000 profit. Do that 5 times, then my 10K made 5K. Although that's 50% net, they made their whole 5,000 goal. Just like that is what people think when they have $1,000 in their small account, and they think that, okay, well, I just wish I had more so I can make more, and that's just the way life is. Now, my issue with this is basically that's a great kind of excuse, but in the end, fundamentally, if your skills are there as a trader or as an investor, if you're making the right moves based on certain research and certain due diligence that you're doing on certain stocks, then basically, according to the time frame you have in plan, in motion, in action, then basically you'll be able to grow your account, whether that's steadily, gradually, slowly, or even rapidly. Because in the end, the point is, if you can make $1,000 into 10K doing some type of process and having a plan, then you can make that same 10K into 100K, or you have 100K into a million into 10 million, and it's not the same. And I understand that as we get into bigger numbers, when we're talking about penny stock tradings, whether you're talking about low floats and then huge price upswings and total gap ups overnight and huge profit potentials in the short term, even Tim Sykes, who's a famous penny trader, says it himself. After a certain point, you could have X amount of millions, but you can't make the same percentage kind of returns. It's just not feasible with the type of volume and activity in certain OTC, over-the-counter type of markets. And I'm speaking from a trader perspective, but if you're an investor, if you want to go from, for example, 1,000 into 10,000, and let's say your time horizon is 20 years, depending on where your money is, that can happen, and it can also not happen. And it depends how you want to allocate, what type of risk you're willing to take, how long you're willing to see that position through. For example, if you look at a company like Colgate-Palmolive, ticker symbol CL, it's a consumer packaged good type of everyday staples type of situation. So if you're looking at toothpaste, if you're looking at toothbrushes, if you're looking at certain products like this, they're always going to be that daily need. But is that going to change? Is that the next hot kind of space industry, electric vehicle industry? Is that going to be the thing that's going to 10x, 100x, whether that's 5 years from now, 10 years from now? What happens after 100 years? So items like this, basically, if you want to grow your account, it's not impossible or not. It's all a mindset of how you're going to do it, what you're willing to put in, how are you going to get maybe extra funds to go into your account. Is it going to be side hustles? Is it going to be getting a promotion at work and planning accordingly? Is it about maybe aiming for a certain type of level of bonus, depending on how maybe your commission structure at work pays out? It doesn't matter if you have a job or a side hustle to get money into the account, because in the end, if you're making money and you're putting into your account, the account will grow just from a principal perspective, and learning and executing, trying, practicing will make it grow, not just today, but for the long term. And you can spread that same information and learn from your mistakes and make bigger gains. And I can keep on going about this because basically having that mindset, it's just a mindset. It's just switching it on and off. It sounds simple, but just trying to take those risks. Like, okay, if I want to make it grow, I may need to risk this much, but if I risk this, is it worth the trade-off? Is it worth risking 10% of my capital to make that into 20% of my capital in the future? Or is this 10% basically going to be it? And after that, mentally, I may not be able to think for short-term decisions, or in the next day or the next day. Items like this. I'm going to sneak this one in because I forgot to mention it, but the final one is really taking on too much risk. We just talked about it, but if you're willing to risk 10% to make even more, and if it's worth it, that's great. But if that's the only 10% you have willing to risk, and you're taking one shot and you can't repeatedly take that same shot or same type of style of shot, and if you're a long-term investor, if you have credit card debt, and that's outweighing basically what you're thinking you're going to earn from your long-term portfolio or otherwise, then basically it's kind of like taking too much risk, because if you're just putting money into something that's compounding, that's going to be debt that you'll have to pay out anyways, that's going to affect your net worth, it is like taking too much risk, because you also may not be able to do certain type of future other investments outside of the market if you're invested into real estate or thinking of it, etc. So too much risk if you're a short-term trader, aka like a day trader, for example, or swing trader, or if you're a long-term investor, if you can't take on too much risk, you may not be able to think the way with that mindset, which makes you basically get a bigger account. That's all it is. Because if you're taking too much risk, you're thinking too much. If you don't take too much risk, but now you can think kind of clearly about what the plan is, what the strategy is, then there's no reason why you or anyone cannot grow their account. So there you have it, 13 mistakes. I've made them, so hopefully you don't have to as well. And please don't make them. And good luck, whether you're a long-term investor, short-term trader, or both. And we'll see you soon enough. Peace.